The United Auto Workers will hold a strike authorization vote next week. It's a procedural step union leaders need to take before members can strike. The news comes about 1 month before the existing contract between the UAW and the big three car makers, Ford, GM, and Stellantis, expires. President Biden weighing in on the talks yesterday, writing in a statement, quote, "I'm asking all sides to work together to forge a fair agreement." And that transitions are, quote, fair and look to retool, reboot, and rehire in the same factories and communities at comparable wages. Here to dig into this and more in the car space, let's bring in Tom Narayan, RBC Capital Markets Lead Global Autos Analyst. Also with us, David Whiston, Morningstar U.S. Autos Equity Strategist. Great to have both of you here today. Tom, regardless of whether there is a strike or not, this all points to cost increases for these car companies. You look at what UAW is asking for, a 40% increase in wages. How do you think investors should be looking at this in terms of the financial impact to car makers?
Yeah, it's no doubt it's catching a lot of headline interests, and there will probably be some cost inflation. But you have to remember the auto industry, especially the car makers, are enjoying record level pricing and profitability so far. That pricing is probably going to normalize. That's a bigger threat, I think, to the auto industry than this one-time hit that'll happen with the strike or financial costs raising somewhat. Remember what happened in 2019? That strike had a big hit in one quarter, and then there was a sharp snapback afterwards. So I think investors are, for the most part, looking at it and monitoring it, but they're really looking past it into 2024. The big topic really for the car makers is pricing and price normalization. That's going to have a much bigger impact.
David, let's stick with the UAW, the strike there, before we get into pricing. From your perspective, how big of a hit, if we do see a strike, could that be to the automakers? And if we don't see a strike, if we do see the automakers concede to some of these demands from the union, what's the impact then?
Yeah, well, the latter part of your question is the massive unknown, because right now the sides are just so far apart that I mean, this is my fifth round of contract talks in my time here, and this is the most worried I've been about any of them because of the gap in the gap to getting an agreement. But what the union's asking for is to really go back to how things were in the 20th century, with everyone having a pension and retiree health care. And I understand the union's perspective on wanting to do that. Many of those workers, I have seen their parents or their grandparents have those benefits, but it's just not economically feasible anymore. So you'd be talking tens and tens of billions of pension liability. I don't think the management teams are willing to do that, even with a strike. And then, the wage part, I think they can afford to do that. It's the pay raises I'm not as worried about. It's all the extra things that go with it, like a 32-hour work week, for example. That means you'd have to hire more people to keep the plants going. It just doesn't make any sense economically.
David, on that point, I'm curious about what these latest negotiations could do in terms of the footprint, if we're talking about the big three in Detroit. I mean, we have seen other car makers move to more non-union markets like South Carolina. Is that the general trend where things are going because of those cost issues?
It's the general trend for everybody generally, except the Detroit three, because I think wherever they go in the United States, they're going to have union representation. Take Ford with their new Blue Oval City complex being built in Tennessee. I would fully expect that to be unionized. You've even seen some of the battery JVs, like GM's Ultium JV plant in Ohio. They voted to join the UAW late last year. Everyone else, you've seen Elon tweeting about the UAW in the past. He's clearly not interested in having the UAW represent his workforce. But with the Detroit three, I don't see that changing. It's just a matter of where does the headcount go. What GM has been saying in terms of the shift to EVs is that you need the same number of people to build these cars, whether it's EV or ICE. Then it's just a matter of natural attrition.
Tom, let's talk a little bit more about pricing, the issue that you brought up earlier. When you come to the fact that so many of these automakers are under a tremendous amount of pressure to lower the pricing of their vehicles, given what their rivals, what their competitors are doing. And we also had the news out today that Tesla's rolling out lower priced options for the Model S and Model X. How do you see these price wars playing out, and how big of a drag this could potentially be for the larger automakers?
Yeah, I think this is really the more important issue versus UAW. I think that's more near term. And so It's going to be a tremendous impact, I think, to near-term 2024, possibly 2025 numbers. That they're not really in people like me. They're not in our estimates. And I think it could be really scary. The one thing I will say, though, is I think EVs, thanks to all of the money coming from the federal government, you mentioned, GM earlier with Ultium. There's a lot of money coming down from the federal government, from the IRA, that's going to subsidize the D3 and automakers in the U.S. to produce cells domestically, and a $7,500 credit per car to do so. You're going to see a lot of price deflation, actually, I think, on EVs the next few years. It's going to be cheaper to buy an EV than it is to buy an ICE. That's how the government wants to entice people to buy EVs here in the U.S. And it actually might wind up being a financial windfall for the automakers here in the U.S. because they're going to be able to produce these EVs cheaper than when they would be able to produce the ICEs, thanks to all of this money coming from the federal government. So I actually think, even though near term there could be some problems with pricing coming down, longer term, thanks to the IRA, that might actually subsidize a lot of these price cuts. And we, the consumers, probably going to be the net beneficiaries.
David, you agree with that? Higher volume but lower price tag as a result of those federal incentives coming through?
Yeah, and I agree. The consumer ultimately is going to benefit because there is of the IRA. There's a lot of taxpayer money to help out with this, and you're already seeing that with when Tesla started with the initial 20% price cut on the Model Y, and then they've kept going with that with further cuts. There are people that probably would have normally bought a combustion model this year. Instead, they're like, you know what, I'm going to go electric and get that Model Y, and the Model Y is driving a huge chunk of the EV market share gains in the U.S. And then on pricing versus volume, yeah, I think this pricing risk thing has been going on all year. Late last year, there's been so much fear about pricing, and the pricing downside hasn't happened in 2023. And I think people are neglecting that volume side too. I mean, remember how bad things have gotten in 2020 and 2021. Inventory is still at about, it's just under 1.8 million units now. Before the pandemic, it was 3.5 to 4.1 million units. We're not probably going back to pre-pandemic inventory levels, but we're not staying below 2 million either. So you've seen this with the supplier earnings this quarter. Don't underestimate the impact of higher volumes, because it does matter even if you have pricing declines. And pricing is not going to collapse like everyone's thinking it is either.
Tom, on the point about the IRA, obviously the price tag lower, but also what we have seen is maybe a year ago when the IRA first passed, there were a lot of car makers who were a little skeptical of how some of these cars would qualify for that $7,500 credit. How much of the sourcing was from North America, where it was manufactured. A year later, to what extent has the IRA shifted the manufacturing footprint for some of these car makers? I mean, are we seeing a wholesale rethink of where these cars are going to be manufactured just so they can tap into those incentives?
Yes, 100%. We actually hosted a factory visit to Ultium's GM Ultium's first facility in Ohio last week. And I can tell you the IRA is a prime reason why they're doing it. $2.6 billion for each facility. They're making back $35 per kilowatt hour as a credit for the cell. $7,500 you mentioned for the price of the car. A Chevy Equinox could be sold retail pre-credit for $30,000. You and I could get it for $20,000 at the same profitability. We heard Stellantis is building in Indiana. Ford noted where they're building in the U.S. as well. So everybody needs to build the cells locally in North America to qualify to get the $7,500 and the $35 credit too, which completely more than offsets that capital expense, the $2.6 billion per plant that GM is doing, totally offset by the federal government. It's like I think it's a total like $1 trillion shift from the federal government to the auto industry and the consumer. So all of these OEMs are trying to jump on this and capture, and we're seeing that momentum already take place.
Yeah, it's been interesting to see how the IRA has taken hold in the EV space. RBC's Tom Narayan and Morningstar's David Whiston. Good to talk to both of you today. Appreciate the time.